Thanks for tuning into this show. The question that we ask as we try and crystal ball gaze into 2024, as futile as that attempt always is whether 2024 is a year of hard choices. A choice of whether to stay invested in risk assets or be in a bit of cash in order to take advantage of any subsequent falls that may come in. A question of whether be invested in equities versus invested in fixed income, considering the fact that rates in all likelihood are going to come down. And multiple other questions as well, multiple other choices to exercise. And I think the team at Barclays have done some good work on trying to forecast quarter one. I'm going to extend that conversation for the rest of the year because as before the show, they told me that it's very difficult to get even 3 months right, let alone a year. So let me get in my guests on the show today. Ajay Rajadhyaksha, he's Global Chairman of Research at Barclays, as well as Amrut, Nashikkar, he's Managing Director of Fixed Income Strategy at Barclays. Gentlemen, both of you, thanks so much for joining in. Great having you.
Thank you, Niraj.
Thanks a lot, Niraj.
Yeah, no, the pleasure is entirely mine. Now, can we start with what's the basic premise that you're laying out for 2024, be it the first quarter, be it extended for the rest of the year?
That a few things will happen. First, the US economy in particular, which has been the vanguard of how well the world has done in 2023, will slow down a little bit, but not to the point where you are even remotely close to a recession. That's number one. Number two is that inflation rates will keep coming down. Not all the way down to 2% by the end of 24, but significantly closer to 2 than we have been at any point in this cycle. And the third is that the US central bank will be in a position to cut rates, perhaps not as aggressively as the bond market is pricing in. I don't think they need to. But if you add all of this up, Niraj, you're looking at a world where the bottom of the US economic cycle is an unemployment rate that never really gets even to 4.5%. Remember when we were all growing up, 5% was full employment in the United States. So a peak of 4.5% on the unemployment rate, if that is the worst that it gets, and you still get close to 2% on inflation, and if you look at everything that the US economy, that the world economy has faced, I mean, look at this year, right? You had very aggressive hiking cycles. You had a March banking crisis in the United States. You had 2 wars in energy-sensitive regions breaking out. You had a bond sell-off for the ages. And through it all, the United States of the last 4 quarters has grown at about 3% real. It's astonishing.
Yeah,
and, this, I don't know what to call it, apart from a soft landing. Sorry, go ahead, Amrut.
No, Amrut, please carry on. I was just agreeing with, out here that it is astonishing and that's the right term to use. But Amrut, yeah, please carry on.
I mean, on the point that Ajay made about the Fed likely not being able to deliver as many cuts as are priced into rates right now, it's quite likely that the market is still concerned about the potential for a hard landing over and above the sort of the baseline path of cuts that's already priced into rates, and that's why we have had such a big rally in rates over the past couple of months. So the pessimism is probably still there, and that still remains to be priced out a little bit.
Okay. Okay. Now, what happens in the event, and either of you can take this, that the rate cut cycle is slightly more aggressive than what you are penciling in as the base case? Because that could happen too, right? I mean, we didn't quite pencil in the central bank to do what it did. The markets always anticipated to do something materially different from what the central bank has done thus far. What if the rate cut cycle is a bit more aggressive than what you guys are penciling in right now?
It depends on why the rate cut cycle is a bit more aggressive. If it is because the economy is falling out of bed, then I don't think a bit more aggressive is the place to use. It's going to be very, very aggressive. Okay. You'll start to see 50 basis point cuts at a clip. But if they just are a little more aggressive, where similar to market pricing, for example, they start in March, they give us 6 rate cuts next year. That is probably in a world where inflation is coming down rapidly but the economy is holding up. And honestly, at that point, you have to own risk assets. I know it sounds a little scary, given how much risk has gone up this year. I don't think there is a choice, and I don't think there is a choice to the U.S. markets either, as one of the vanguards of what's happening.
That's interesting. And just a follow-up there, and then I'll come to the fixed income part as well. But the common folklore, as is given out, is that in a period like what we are predicting 2024 to likely be like, there would be a gush of money moving towards emerging markets, likely because of the very reasons that there is a rate cut cycle. It may not be as swift and as deep as the markets may believe, but there will be one. And I hear you say that the vanguard will be the US markets and it will probably be the numero uno choice. Is it because of the depth that it will provide? Or do you reckon returns-wise, we'll probably see emerging markets do much better than the developed markets, particularly the US?
So we don't think emerging markets will do much better, especially on the equities side. And the reason is because of one word, China. You're talking about an economy that directly and indirectly is about 50% of the emerging market overall index. And the fact of the matter is that after a brief, spurt in the first quarter of this year, the Chinese economy has consistently disappointed. It still is disappointing. Today, as you see, Chinese stocks continue to fall out of bed. It is very hard for emerging markets to outperform the US, risk adjusted, of course, right? When something that contributes almost 50% of weightings is still struggling to find its feet. Now, if you're asking about Indian equities, the Indian economy, it is very hard to find fault with right now. The country truly is in what you call a macro sweet spot. You guys are the experts. Amrut and I, we look Indian, we sound Indian, we grew up in India, but the fact is that we spend all our time on global macro. But from New York, what I see is an economy where private credit is growing in the double digits, where public sector banks already took their lumps, where private sector banks have healthy balance sheets, where private sector households are in very good shape, and the demographics are good. The economy benefits from the China plus one narrative. So it's hard to find. Now, look, the equity market is priced for it. I will grant you that, Niraj. But even with that, if you ask me about an emerging market to invest in, I would probably say, yes, you're right. Indian equities still look attractive. But emerging markets as a whole, I don't think they're going to outperform the US.
Okay. I'll probe that point a bit because that is of interest, of tremendous interest to a large portion of our viewers as well. But Amrut, I want to bring that question to you about the fixed income versus equities debate. Now, Ajay said that equities might do better than fixed income. There was a point that you guys have made in this note that one of the aspects could be that the fiscal profiles of developed economies are worryingly poor, and therefore in such a scenario it might be difficult for fixed income to, bonds to be as attractive. Now, is that the principal reason? Because overarching view is that, that with the rate cuts being in place, go out and make this trade because it seems to be a heads you win, tails you don't lose too much kind of a trade.
I would definitely say it's one of the main reasons why we are cautious about fixed income. Look, we had a $2 trillion deficit in the US in a year in which the economy was actually doing pretty well. So you can only imagine what the fiscal profile looks like if you do get an economic shock. There's just going to be far more issuance, and more importantly, some of these problems are structural in the US. So you want to have more term premium as compensation for taking on all that duration risk. So that's definitely a reason. The second reason I would say is the number of cuts that are already priced in. And there is some scope for disappointment in terms of what the Fed is actually able to deliver relative to what's priced in. So if the Fed delivers fewer cuts than what the market is expecting, then that would be another reason for fixed income not to do all that well.
Okay. What about? I don't know how closely you look at other global fixed income assets as well, but There is.
Oh, we do. Go ahead.
Perfect.
Yeah.
So, the question would be that in cases like India, which has got an idiosyncratic reason of being included in the JP Morgan bond index and eventually talk of Bloomberg index and so on and so forth, what does that do to the fixed income market of a nation like India?
It helps it enormously. It takes time, mind you. And you can argue that it depends to some extent on how the central bank performs, how the economy performs. But a country like India, where you're talking about inflation that has basically bounced between 5 to 6% for a while, where there is an inflation targeting framework in place, which hasn't had any of the capital flight issues that, a few years ago China faced, for example. And where, quite bluntly, Niraj, the financial markets are reasonably to very sophisticated. The capital account is just not open enough. That's the one thing that makes it different from a developed economy in financial market terms and fixed income terms. But, you're talking about over time, the risk premia continuing to go down unless the country goes out of its way to do something that screws things up. Run a very high fiscal deficit for years and years, aggressively monetize sovereign debt, not keep inflation rich. You can make mistakes, but in the baseline, it's a very good thing it won't happen immediately, but it's a very good thing for the fixed income markets of an emerging economy.
Amrut, you want to add to that?
I would say that it's a combination of factors, but certainly index inclusion is one of the big events, and more importantly, it sets up the stage for inclusion into more number of indices over time, and also attracts more international fixed income interest.
We'll take a very quick break, viewers, on that note. Come back and talk in a bit more detail about India and other EMs relative to what's happening in the Western world. Stay tuned. Thanks for staying tuned to Outlook 2024 in conversation with the men at Barclays from New York and Ajay as well as Amrut. Thank you for this conversation once again. Now, I want to tilt a bit towards EMs and India. You give us a brief flavor. I heard Ajay say that if he's one emerging market that he would think is in a sweet spot, I'm not quoting verbatim, that's India. Amrut mentioned that the Indian landscape for inflows, etc., looks pretty positive as well. I want to start with you, Amrut, and you guys give a brief flavor about how this is not an immediate trigger, what happens to by virtue of this inclusion into the bond markets, but it's a sustained one and more indices could come in as well. A lot of people have argued that in some sense this inflows into bonds plus equity inflows plus FDI inflows, etc., will probably shift the way the currency in some fashion behaves as well. Now, I don't know how closely you look at USD INR per se, but if you have a view on Indian bonds, Indian rupee, over the next 3, 4, 5 years, would love to hear that.
One thing I would say is that if you look at the rupee over the past couple of years, in general, it has tended to hold up quite well to all the shocks that have hit the rest of the world. And I think that's a sign of the fact that the financial markets recognize some of the structural strengths for India. I mean, look, our view is that from a structural perspective, the Indian economy is sound. Ajay laid out a number of reasons for why Indian asset markets in general are likely to be attractive. And as long as you have inflows going on, then that should help keep the rupee strong, or at least prevent it from depreciating as much as some of the other emerging market currencies could.
Mm-hmm. Ajay, you want to add to that?
Yeah, the fact of the matter is, Niraj, that all emerging market currencies have trend depreciation against the dollar.
Right.
That's been true for the last 20, 25, 30 years because the dollar benefits relentlessly from financial inflows into the United States. Amrut and I both left India at the turn of the century. You know, it's been over 20 years. And if you asked us at any point over that period where the rupee would be versus the dollar in the next 6 months, it might go, you know, our opinions might go back and forth. If you ask us over the next 3 to 4 years, it will almost certainly be weaker against the dollar, but that's not the right benchmark. The benchmark should probably be a broad-based EM FX basket. And the fact is that the rupee, for the reasons Amrut mentioned, has very, very comfortably outperformed this EM FX basket in the last year. And I think will probably continue to do so.
Okay, but you don't believe in the theory of peak dollar anytime soon. There are a number of proponents who say that.
Those same proponents also said that at the start of 23 and the start of 22 and the start of 21. There is an argument to be made that the fair value of the dollar has actually gone up over the last several years. I mean, look, the United States has lots of problems. There's a fair amount of political dysfunction. But think about who the alternatives are, right? After the GFC, the Euro area and the United States were similar-sized economies. Now the United States is 50% larger. The Chinese economy, hobbled by demographics, overinvestment in housing, capital flight out, it has missed its moment in the sun at this point. We do believe that as a counterweight to the US, at least from a currency standpoint. I mean, Niraj, a basic thing to put up, if you want to put up a currency as an alternative to the dollar, is that the capital account needs to be fully open. Even that is not the case when it comes to China, right? And we don't think the capital account is going to be open for a long time. So no, the argument of peak dollar it's great dinner table conversation. It's something that keeps coming up over and over and over, and it's almost always wrong. We don't think we are at peak dollar.
Okay, so when we are thinking of 2024, inflation should fall, I quote, but not rapidly enough to spark big monetary easing cycles. Stocks more appealing than bonds at these levels, and India, by and large, looks attractive enough, even if EMs as a basket may not, because of China. Now, my question is, gentlemen, perched from where you are, you would have heard about the India attractiveness a number of times and problems around flows into India, both into stocks and bonds, a number of times as well. I would just love to understand if this time is different, because corporate conversations around FDI into India are very attractive, but the actual numbers, not as much, right? Flows have been okay. So do you sense that this time around is slightly different? Can 2024 show that this time around is slightly different for India?
I think it is a continuum, to be honest. Sorry, go ahead, Amrut. You take this.
No, I mean, so I will say that it's always difficult to say whether this time is truly going to be different. So what we can share is only our perceptions about what it feels like.
Sure.
And it certainly feels like with the China plus one story and relative demographics which are looking quite attractive, investment spending in India, all those stories are certainly they feel like they are adding up to something that is more significant than, at least in my experience, I've heard in the past couple of decades.
Okay. Ajay, you want to add to this?
No, I would say 2023 and 2022. 2022 was when I first started hearing that this time truly was different for India. I actually think it has been. I mean, look at the rupee outperforming EMFX. Look at the fact that Chinese equities trade at 9 months, 9 times 12-month forward earnings. Indian equities trade at more than twice that.
Yeah.
That is the market, voting with its feet, having a vote of confidence in India. I think this cycle is different, and 2024 will be a continuation of that. Yes.
And long-term money, because just the last point on this show, into whichever asset class, but the conversation always has been that India has been a recipient of EM-dedicated flows, not India-specific flows in a meaningful way. Yes, there have been stray instances, but not in a meaningful way. Are you now sensing within the landscape that you guys look at that will also start happening, wherein India-dedicated flows, people who haven't looked at India thus far might now look at India very seriously?
Absolutely. I do want to not get too carried away, Niraj.
Sure.
So first, look, my world is global macro, right? So all of the global economies, interest rates, affects commodities. And I will tell you that in the last 6, 9, 12, 18 months, India has shown up far more in conversations than at any point in my career. There's no question about that. The country has hit critical mass. It is one of the largest contributors to global growth. It doesn't hurt that the Indian American community in this country has done extremely well in many areas. That's helped too, perhaps. So, but I think we are still a ways away from India-dedicated funds in the West being a substantial asset class. I still think there's a tendency to think of, in terms of long money, right? Tendency to think of it as EM money and non-EM money. And it will take a while before that changes. India's share of that EM money will keep going up. But I don't think you're at the point of India-dedicated funds being a big player yet.
Got it. Gentlemen, thank you. I went beyond the scope of just the note that you've written, maybe beyond the scope of what profiles you guys per se follow. But it was lovely to get this perspective of all the work that you've done, plus the origin, your views on the origin country that you are from. So lovely to have both of these perspectives from both of you. Thank you so much for taking the time out and being with us on the show today.
Thank you.
Yeah.
Thank you.
Now, the pleasure was entirely ours, and viewers, thanks for tuning into this episode of Outlook 2024.